Actually, the game is about to change. It's about to get a lot nastier. And given that the US market is trading at bubble levels, that there are the capacity for huge capital losses.
Welcome back to Breakout with Breakingviews, brought to you by PGIM. I'm Peter Thalas, and the acting global editor of Breakingviews, and I'm speaking to Edward Chancellor, who is joining us as usual from the British countryside. Eddie, welcome back. It's good to see you. Quite a lot has happened since we last had you on this show. Inflation has come roaring back. Central banks are raising interest rates around the world. And most recently, of course, Russia has invaded Ukraine. You've been thinking about what all of this means for investors, and in particular, what you call the battle for investment survival. What do you mean by that phrase?
Well, as you say, quite a few things have happened in the first quarter. And I would say, from an investment perspective, that we are seeing the underpinnings of the great US bull market, one of the great bull markets of all times, have been taken away in this last quarter. Now, the market, the S&P 500 is only down sort of around 4%. So it that might seem like a small setback. But if you think about it, what created the great bull market? It was the decline in inflation, falling interest rates, the advance of globalization, and the advocacy or companies' embrace of the shareholder value management philosophy. Now, if you look at the last few months, all of those trends appear to be in reversal.
So you're well known as a financial historian. You're obviously taking us delving back into the past for sort of signposts and guides of how we might sort of navigate this period. And I think you've ended up in the mid-1930s. What can we learn from that period that would be useful today?
Well, in 1935, an American stockbroker called Gerald Loeb wrote a book called The Battle for Investment Survival. And this book is considered an investment classic. And Gerald Loeb was the contemporary of Ben Graham, who's much better known, the mentor of Warren Buffett. And Ben Graham, as you may know, advocated a buy and hold mentality. Now, the trouble is that Ben Graham actually lost 60% of his portfolio in the October 29 crash, whereas Loeb, by his own boasting, claims to have been out of the market beforehand. And what Loeb is saying is that investment is a hopelessly difficult task, that markets are dangerous, and the best strategy for an investor is to move in and out of the markets quite quickly, rather than adopt a passive approach to investment in which you're fully invested. Now, if you think about it, over the last few years, those who have done best are those who've just bought the S&P 500 index and gone to sleep. And last year that returned 29%, including dividends. So that really is sort of investment genius. But I'm arguing that actually the game is about to change. It's about to get a lot nastier. And given that the US market is trading at bubble levels, that there are the capacity for huge capital losses. Now, think about then the problem of inflation. And here I cite a piece by Henry Maxey, who's the chief investment officer of the London-based firm Ruffer. And Maxey's written an interesting essay recently in which he argues that when inflation comes into the system, it doesn't come in a straight line, it comes in these sort of waves. And he says there's no point investing for the end game, the inflation end game. You have to be, and here he's a bit like Gerald Loeb, you have to be a lot more nimble. You have to, on the upside of the inflation wave, which we've been going through for the last few months, you want to be preparing for the inflation. So if you remember last year, I was advocating sort of buying things like energy stocks. But now those have been on a tremendous run. Now the next phase, with the Fed tightening and obviously a very tiny 25 basis points from zero is, is not the end. That's not the end of the tightening. So the next phase, as Maxi describes it, is the inflation down wave. So if you're going to invest in that way, if you're going to sort of take that on board, then you actually need to be a lot more nimble. And dare I say it, and this is something that is considered complete heresy in the investment world. Dare I say it, you need to engage in a bit of market timing when they're moving in and out. So the central thesis is that passive investment has done tremendously well and bully for those S&P index investors, but now actually is the time to get active.
I mean, this runs contrary to all of the sort of the investment advice that you read in magazines and newspapers and things. As people say, don't try and time the market. You'll only get it wrong. You'll get out when the market's low and you'll go back in when it's high. Don't try to pick stocks. And just keep your costs as low as possible. Buy an index fund and just sit on it. And that's the best thing you can do, because anything else you might do will be worse.
Market timing is a perilous activity. However, and I used to work for this investment firm, GMO, where in the asset allocation, we did try and forecast markets, at times better, sometimes better than others. But the essential point then, these forecasts were developed in the late 1990s, was to say that some markets are cheaper than others and you don't want to be in a bubble market. Now, Jeremy Grantham, my old boss, has put out a note earlier this year pointing out that the US stock market is a 3 sigma bubble. That's 3 sigmas away from its long-term trend. Now, if capitalism has any sort of meaning, it's that what goes up comes down, that there is a reversion to the mean. So I think that, yes, market timing is difficult, but in bubble moments and extreme bubbles that you see at the moment, then that's a different matter. The other thing I would say is that in inflationary periods, as I mentioned earlier, markets get whipsawed. Now, if you go back, I didn't actually mention this in my piece, but as you know, in the 1970s, the US stock market actually lost value. And I think in real terms, a balanced portfolio of 60% equities and 40% bonds declined something more than 50% in real terms. So clearly, in an inflation time, if you're buying stocks in a highly valued market, are not going to protect you from the return of inflation. So I'm afraid, that if you want to protect your capital from now on, you're going to have to get out of bed, or at least ask someone else to get out of bed and do the job for you.
Well, there we go. So it's there's a bull market coming in active investment managers, which it's been a long time coming potentially. But it's interesting your point, because it sounds almost like the adage that people used to say during the 2008 crisis. It's now become about return of capital rather than return on capital.
Yeah, and or Peter, another way of saying it is it's the preservation of purchasing power over time. That is as far as I'm concerned, that should be the prime aim of investment. And if you can get any supplemental return, well, good for you. But first of all, preserve your capital. And that may require being a tiny bit more nimble than you've been in the past.
Eddie, thought-provoking as always. I'm sure there are many of these themes we will be returning to in the coming weeks and months. But for now, Eddie Chancellor, thank you very much.
Thanks.